Okay, so this is the fifth lecture. We're going to talk about the effect of taxes on savings, capital gains, and transfers today. So your reading for this week was chapter 22, as well as two sections of chapter 23. We'll continue with the rest of sort of capital taxation in terms of corporate taxation next week. Okay, let's get started. So first we're going to talk about taxes and saving. We're going to talk about three models, three ways to model sort of the impact of taxes on saving. The first being the intertemporal choice model, the traditional model. Then we'll talk about precautionary savings. And finally, we'll talk about some behavioral models of how people decide how much to save. We'll talk about capital gains taxation, so the effect of capital gains taxation, some concerns when it comes to capital gains taxation. And finally, we'll talk about transfer taxes. Transfer taxes are gift taxes and estate taxes. It's the tax levied on the transfer of an asset from one party to another. Usually triggered by death. It's usually parents to their kids, but there's some other ways you could also imagine taxing an estate as well, or having an estate transfer as well. Okay, so there was some issues last week about the video being posted online. The system was down, NYU TV's system was down. It is up now, and from now on, I think it'll be sort of a standard turnaround. So if you had any issues viewing this video, viewing the video last week, it's up now. So okay, terrific. Okay, taxes and saving. So when we tax the returns to saving, we reduce the incentives to sort of the return to saving, right? We tax interest payments, we reduce the return to saving, and that's going to change the way people think about the choice to save. And the question is, on net, does it encourage or discourage saving, right? That's what we really care about. Well, like all taxes, right, taxing the return to saving is going to have two effects. The first being the substitution effect, the second being the income effect. Like in many other situations, here, these two go in different directions. When we think about, let's go ahead and, the net effect is actually ambiguous. Let's go ahead and look at the model. So first, before we even talk about taxes, I want to sort of talk about the intertemporal choice model. So the intertemporal choice model, like the labor supply model, right? In the labor supply model, we didn't model labor supply, right? We modeled the choice between consumption and leisure. Because we find it difficult to talk about bad things, we always model choices between two good things. So here, we don't think of people deriving direct utility from saving itself. Rather, they derive utility from the consumption they can finance with saving. So here we're going to model the choice between period 1 consumption and period 2 consumption, where we're sort of defining these periods as very large sort of spans of time, the first period being your working life, and the second period being your retirement time. So the first period is the time where you have income, the second period is the time where you don't have income, but of course you're going to have some consumption, right? And savings is the means by which you transfer income from the first period to the second period to finance consumption in the second period. So we're modeling the choice between consumption while working, i.e. in period 1, and consumption in the second period, period 2. There's a budget constraint, and like all budget constraints, the budget constraint tells us the opportunity cost of one good in terms of the other, right? Here, it's the rate at which we transfer period 1 consumption into period 2 consumption, right? That's the price. That's the opportunity cost. Because for each unit of period 1 consumption we forego, we can then consume 1 plus R units in period 2, where R is the interest rate that the savings vehicle affords. Excuse me. Come on in. That's okay. Come on in. Oh, you know what? If people are late, just keep it kind of cool. Okay, so savings is the vehicle by which you transfer income from period 1 to period 2. Of course, anyone else need slides? Everyone good? Okay. And so the interest rate is sort of your rate of return, and so each unit of consumption foregone in period 1 gets you 1 plus R units in period 2. That's our initial budget constraint. That's the blue line. The individual is going to find a tangency point between their indifference curve and that budget constraint, right? And that's going to determine their period 1 consumption. And the difference between potential period 1 consumption, right? If we spent all of our income on period 1 consumption, we could consume Y. Similarly, if we saved all of our period 1 income, we could consume Y times 1 plus R, right? R is something like 3% or 5% is the rate of interest. So we could consume Y times 1 plus R, right? And every combination between is the line. When we find our point of tangency, right, between the indifference curve and the budget constraint, that's going to lead us to consume some level of C1. The difference between C1 and Y is going to be our savings, right? It's the part of our income that's not consumed in period 1 and will instead be saved. We will then be able to consume in period 2 the amount S times 1 plus R, right? That's what this level is here. S times 1 plus R. Okay, so that's the initial intertemporal choice model, right? The person is choosing between consumption in period 1 and period 2. Intertemporal just means between time, right? So between these two time periods. Let's go ahead and levy a tax. What's going to happen when we levy a tax? How do we tax interest? We only tax your interest payment, right? Suppose you put $100 in a bank account. Let's say you earn 5% interest. We don't touch the $100, right, when we tax interest payments. We tax only the $5 of interest, right? So we reduce the interest rate, the effective interest rate. We don't touch the actual principal. That's why when we think about when we tax interest payments, what we're going to do is we're going to change the slope of this budget constraint, right? We're going to reduce the rate of return. The rate of return is going to fall from R to R times 1 minus tau. Because you're going to pay to the government R times tau. What will remain with you is R times 1 minus tau. I often refer to 1 minus tau as the keep rate. It's simply the share of your return that you get to keep, the fraction you get to keep versus send to the government. Tau is what you send to the government, you keep 1 minus tau. Okay, so our rate of return on savings has fallen from R to R times 1 minus tau. I'm sorry, your name, I can't remember. Siobhan, that's right, I ask you every week, yes.
I don't mean to take you back, but
no, it's fine.
Say the S times 1 plus R.
Yep, that's this one.
Can you explain that?
So,
That's what you said.
okay, so this individual finds, let's give her a name. Let's say her name is Kim. There's no Kim in here, right? Okay, good. So Kim finds a tangency point between her indifference curve and her budget constraint. That's what determines her period 1 consumption, right? So we can look at this. It also determines her period 2 consumption, right? That's what these two coordinates are. And what I'm saying is that we know that if she consumes this in period 1, she's going to save the difference between her full income and C1. That's savings. It's the residual. It's sort of like labor and leisure, labor. And she's going to take S, put it in the bank, and be able to consume S times 1 plus R in period 2. That's all. Okay, awesome. Then we're going to levy a tax. We're going to levy a tax and reduce the rate of return from R to R times 1 minus tau. That's going to be modeled as a rotation downward of the budget constraint. Why? Because we can still consume Y in period 1, right? Our full potential consumption in period 1 is unchanged. But what has changed is that if we chose to save all of our income Y now, we would only be able to consume Y times 1 plus R times 1 minus tau, right? That's fallen. So it's fallen down. It's gone down, so we rotate the budget constraint in. Now the question is, what's going to happen? What's going to happen to what's going to happen to savings in light of the tax? Well, there's two effects, right? Is there a change in slope of the budget constraint? Yes, right? What does that always signify? There's going to be a substitution effect. Okay, so what's happened here? The opportunity cost of consumption in period 1 has fallen, right? All goods are normal goods that we talk about. So if the opportunity cost of period 1 consumption has fallen, is this person going to consume more or less in period 1? More, right? Because the opportunity cost of period 1 consumption has fallen, i.e. the price of period 1 consumption has gone down. You're going to consume more in period 1. If you consume more in period 1, the substitution effect is going to lead you to save less, right? But is this person richer or poorer after the tax? Poorer, right? Because the tax has reduced their potential set of consumption, right? So if they're poorer, they're going to consume less in all periods, including period 1, which will lead them to save more. So the substitution effect of the tax leads this person to save less, while the income effect leads them to save more. The net impact is theoretically ambiguous. Notice that when we talked about the impact of the substitution effect and the income effect, we talked about them only in terms of period 1 consumption. That's the straightforward part, right? The way that the change in savings translates into changes in period 2 consumption is the net impact of the two of them, right? So tell me about the effects of the substitution effect and the income effect in terms of period 1 consumption, just to keep it straightforward. That make sense? Okay. Remember when we talk about whether the substitution effect is causing us to consume more or less? We're always comparing across budget constraints, right? Not across segments of the same budget constraints, always across budget constraints. Okay, let's move on. Oh, I want to say one more thing. So the point of tangency, right? So okay, we'll come back to it. So we said that the initial point of tangency is point A. Where this person, their optimal level of consumption in period 1 and period 2, right? So their tangency point is determined by two things. The first thing is their sort of impatience level. How much they discount the future relative to today, right? That's one factor. The second factor is sort of the rate at which their marginal utility declines, right? That's sort of very similar and related things, right? So I'm saying the same thing. it's sort of the curvature of their utility function, right? The speed at which marginal utility declines is going to affect where their tangency point is. Because what that's really telling you, the rate at which marginal utility declines as you kind of go along the curve, right? That slope, how quickly it changes, tells you how much this person likes consumption smoothing. So if they really like consumption smoothing, they're going to want to consume very similar amounts in the two periods, right? They're going to want to have very balanced consumption over time. How much they discount the future relative to today is about their impatience. So those are the two factors that affect sort of where they choose to have their period 1 consumption relative to their income and how much they choose to save. Okay, so let's go ahead and do a practice problem. So Bob lives for 2 periods. He earns an income of $30,000 in the first period, and his savings earns a rate of interest of 10%. His interest income is taxed at 30%. So please go ahead and draw his intertemporal budget constraint, the same sort of picture we just saw, before and after the tax. Go ahead and label the formulas for all the relevant intercepts and the consumption points. And please go ahead and draw the indifference curves that meet this condition. Suppose Bob saves $12,000 before the tax, and that the income and substitution effects exactly cancel each other, so that the tax has no effect on his savings. Draw both indifference curves before and after the tax, the ones that are tangent to each budget constraint, and go ahead and tell me what's Bob's after-tax consumption in period 2. So I'm going to wait a few minutes for you guys to do this. And just go ahead and look up at me when you're finished, so I know that you're finished. Oh, I don't think it'll take a few hours. I think it'll take a couple minutes. Maybe not a couple, maybe a few. just about another minute. Okay, let's go ahead and take a look at this. So let's first look at the question really quick. So one of the key things, right, often in economics, right, when we say something kind of weird, we're usually making something simpler. Like in this case, what's weird? The income effect and the substitution effect cancel each other out, right? So his savings is left unchanged. So the amount he's going to consume in period 1 in both cases is going to be the same. The only thing that will change is how much he can consume in period 2 because his rate of return on the same level of savings has changed, right? Okay, let's take a look at it. Okay, so we have the initial graph, right, where the slope is the untaxed rate of interest, right, plus 1. So the slope's going to be negative 1.1. Then we go ahead and tax his interest payments, right? Remember his interest rate was 10%. We're going to tax him at 30%. So his effective interest rate will fall from 10% to 7%. So the slope of that part of the new budget constraint will be negative 1.07. So we know initially he was at point A, where he was consuming $18,000 and saving $12,000 of his $30,000 in period 1 income. In period 2, in the second case, we've levied a tax, and we know in this special case, his preferences are such that his income effect exactly cancels out his substitution effect. So his level of savings will be unchanged. It remains at $12,000. His period 1 consumption will still be $18,000. Except now, his $12,000 of savings will not lead him to be able to consume $13,200 like he did in the untaxed case, right? His rate of return has fallen from 10% to 7%, so he'll only be able to consume $12,840 in period 2. 1.07 times 12,000 rather than 1.1 times 12,000. Pretty straightforward, right? Okay, so this was a special case. What made this case so special? The income effect canceled the substitution effect. That's not always going to be true, right? Typically one will outpace the other, and we'll have a net change in savings. Let's look at one case. So recall how this worked. When we tax your interest, when we tax your interest income, what are we doing to the opportunity cost of period 1 consumption? We tax your interest income. The return to savings has fallen. So the opportunity cost of consuming an extra dollar in period 1 has go down. So we're going to consume how much in period 1? We're going to consume more or less? More. So the substitution effect is going to lead you to save less. Exactly. The income effect, on the other hand, you're poorer now, right? Because we've reduced your rate of return. You're poorer, so you're going to consume less of everything, including period 1 consumption. And so your savings rate is going to go up. Okay, so let's think about the case where the substitution effect is bigger than the income effect. This means that your savings on net is going down, right? So that means that if I tell you your substitution effect exceeds your income effect, if your initial equilibrium point is A, your initial tangency point is A, if I tell you your substitution effect is bigger than your income effect, you know that your new tangency point will lie somewhere to the right of A, right? Because we're saying that on net you're saving less, so you're going to consume more in period 1. Exactly. Good. Okay, now a question I could ask you is if I give you the initial tangency point A, I could ask you to go ahead and draw an indifference curve that signifies the preferences of a person whose substitution effect exceeds their income effect, and you would then draw an indifference curve that's tangent to the new budget constraint somewhere to the right of the initial equilibrium, right? Okay, that's the one thing I could ask you to do. Okay. Now let's think about a situation where someone's income effect exceeds their substitution effect. In this case, right, the fact that they're poorer leads them to consume less of all goods, including period 1 consumption, so that leads them to save more. Still, their substitution effect is such that the opportunity cost of period 1 consumption has fallen, so they can consume more in period 1 and thus save less. But the net impact of the income effect is bigger than the substitution effect, so the net impact is actually an increase in savings. We're going to have a new consumption level that's to the left of the original one. right? Everyone with me? Am I rattling this stuff off faster than it's sort of getting through, or it's okay? Tell me. Slow down a little bit, like let's say 10 to 15% slower? Okay. Okay, so I'm gonna actually say it all one more time, just so we are clear. Because I know we've talked about this stuff a million times, but I want you guys to get 100% on the midterm on this stuff, right? Okay, so when we tax the interest income an individual gets, we're reducing the rate of return on their savings. When we reduce the rate of return to savings, we reduce the opportunity cost of period one consumption. In other words, the price of period one consumption has gone down. That's going to lead the individual to consume more in period one due to the substitution effect, and thus save less. At the same time, when we reduce the rate of return someone can get from saving, they're poorer, right? And that because they're poorer, they're going to consume less of all goods, including period one consumption, and thus they would save more from their income effect. Theoretically, it's ambiguous whether taxing savings is going to reduce or increase savings. It depends on whether the income effect is bigger or the substitution effect. What's funny is when we read media portrayals of tax cuts, right, or tax increases, which effect do they always talk about? Substitution effect, right? Because we always hear things like, well, you know, if we hear sort of people talk about taxes colloquially, they say, well, you know, we're going to cut taxes on X, and we're going to get more of X, right? That's sort of the way we hear people talk about taxes. So that is the substitution effect, right? People talk about taxes if there is no income effect. And colloquially. I mean, some people think about income effect, but they're typically not writing for newspapers. Anyone a journalist? I always get one. Okay, well, if any of you decide to go into journalism, spread the gospel. Income effects matter, right? Okay, excellent. Let's go on. Okay, so we've talked about sort of the basic intertemporal choice model and broadly how taxing the returns to savings changes the incentives to save. And we've decomposed it into substitution effects and income effects. Now let's talk about sort of what actual policy looks like and how we would model it. So in the US, we actually have some subsidies for saving. In particular, we subsidize saving for retirement, long horizon savings. So we offer a variety of tax incentives for retirement saving. A few of them are, well, you're allowed to deduct deposits from deposits into certain kinds of saving vehicles, like IRAs and 401ks. If you're low enough AGI, you can actually deduct those contributions from your taxable income, right? You don't pay taxes on the interest earnings in these accounts, right? So the way it works, right, let's talk about a traditional IRA. Not a Roth, but a traditional IRA. What you can do, let's assume you're low enough income that you don't face the phase out, right? You're fully qualified to put in up to $5,000 into your traditional IRA. So what you get to do is you're going to put $5,000 into your traditional IRA. You get to deduct $5,000 from your taxable income. So before you even figure out your taxes owed, you get to deduct $5,000 there. You put that $5,000 in the IRA account, right? So you earn interest in the first year. Let's say it's a 10% interest rate. So you earn money on the $5,000. You earn $500 of interest. If that was a non-tax preferred account, what would you then have to do on that $500 of interest income the next year? Pay interest taxes, right? In fact, how is interest taxed in the US? Anyone remember? At ordinary income rates, right? Just like it's labor income. There's no tax advantage to interest income like there is for dividends and capital gains. So you would pay ordinary income rates on that interest return. Let's just imagine it's just regular interest, right? But because it's a tax-favored savings vehicle, it's a traditional IRA, you don't have to pay taxes after that 1 year. You could just keep that $500 in there. So the next year what happens? You earn interest on the $5,500 you have in that account. And again and again and again. So for a traditional IRA, right, there's the fact you didn't pay taxes to begin with, right? There's the time value of money piece of it, because you're going to pay the taxes upon withdrawal, right? So when you pay them in the future, it's less in PDV terms, right? Second, you basically get the interest earnings on the taxes you should have paid, but you didn't pay, right, because it was deductible. And finally, you get the interest on the accruals, right? You didn't pay the taxes as the interest was earned every year. You get to keep the interest on all of that too, on all the taxes you would have owed each year. Does everyone see the three sources of sort of tax advantages? Okay. So this last piece, pay income tax on withdrawals upon retirement, that's the time value of money, right? Even if it was the same exact tax payment, because you're making it way in the future, it's less in PDV terms. The second part, pay no tax on the interest earnings, that's the inside build-up part, right? That's the fact that you don't have to pay taxes on the interest accruing to that investment every period. And the first part is you get to deduct it from your income tax, and thus you get the interest on that initial tax payment as well. The other piece to this also is that for many people, their income in retirement is lower than their income when they're working, right? So their marginal tax rate at retirement is actually lower than the marginal tax rate during their working years. That's the final benefit. It's not true for everybody, right? But it's true for many people. Okay, so there's a few different flavors. I talked about the traditional IRA just now. There's a few different flavors of these sort of tax-favored savings vehicles. There's 401k accounts, which your employer runs for you. There's 403bs, which are a different variety of sort of an employer account. There's IRAs. There's two kinds of IRAs, right? Traditional, what we just talked about, where you deduct the contribution from your taxes today and pay the taxes when you take the money out. There's also a Roth IRA, in which case you pay the taxes today, but don't pay any taxes when you take the money out when you retire. And then there's KEOG plans. KEOG plans are for the self-employed because they don't have all of these opportunities available to them through their employer. We give them sort of one big, generous KEOG subsidy. Okay, so the rationale for these subsidies are moral hazard, and the fact that savings can help with economic growth, right? It helps sort of foster economic growth. Let me explain these two motivations. Part of it is, so why do we want capital in the economy? Why is capital important to an economy? What happens to wages when labor works with more capital? What happens to productivity when labor works with more capital? Productivity goes up, right? Well, each worker is more productive the more capital they get to work with. Imagine working with an abacus versus a calculator, right? You're more productive with the calculator. Exactly the same way your productivity as a worker goes up, the more capital you work with. Wages sort of reflect productivity, right? So workers are in fact better off when they have more capital to work with. But the thing with capital, right, is that we can't always instantaneously produce capital. Capital is built up over time. You have to have an accumulation of savings, right? Unlike if I changed your labor taxes this period, you could instantaneously reallocate your time towards working rather than leisure, right? Savings comes from sort of incremental savings over time, and so it needs to sort of be built up, and we need to sort of support it. And so if we want capital in the economy, we have to sort of foster savings over time, right? That's part of the motivation for having savings incentives, is to sort of encourage capital formation in the economy. There's also the idea that we think people don't save enough for their retirement. So that's like the macro level stuff, right? We want capital in the US economy, we're going to encourage savings. There's also this concern that, even with Social Security, a lot of people are sort of not saving enough for retirement, right? That people are kind of not taking the expenses of retirement seriously enough to sort of save appropriately for them. So we want to give them a little bit of a break and kind of encourage them to be putting money away by incentivizing retirement savings. So the two sort of motivations for having these sort of subsidies, and these are the forms they take, and this is exactly where the subsidy comes from. Okay. So let's go ahead and model what a tax subsidy to retirement savings does. So our blue line models the budget constraint for a savings vehicle that's taxable. It's like a regular bank account, right? So a regular bank account, you get interest rate R, but you have to pay taxes on your interest earnings at rate tau. And so the slope of your original budget constraint in a non-tax favored savings account is simply going to be negative 1 plus R times 1 minus tau. Please note again that the 1 minus tau only multiplies the R, right? Because we don't tax your actual principal, we just tax the interest you gain on that principal. So that's your original budget constraint in this model, right? Because we're starting off with a regular non-tax favored savings account. Now suppose the government starts to offer a retirement savings subsidy, such that the effective tax on interest rates, or the effective tax on interest income falls from tau to rho times tau. Rho is some number between 0 and 1, right? It's some sort of discount on the tax rate. Let's say you get a tax credit for half of the interest tax payments you would otherwise owe. In that case, rho would be 0.5. Exactly. So by reducing your effective tax rate on interest income, we're increasing your rate of return to savings, and thus your budget constraint is going to rotate upward, right? In a very basic sense, subsidies for retirement savings are like negative taxes. We have a tax, which is the blue. We have a full tax, which is the blue budget constraint. We reduce the tax rate. It's like the opposite of taxing, right? It's sort of the opposite model of what we've looked at. Okay, so we go from the blue budget constraint to the red one because we've reduced the tax on interest income. We have increased the rate of return to savings. We've increased the slope of this budget constraint. And what else have we increased? The opportunity cost of period 1 consumption. Right, when we change the rate of return, so in the original budget constraint with blue, each dollar you consume in period 1 means you can't consume you can't consume 1 plus r times 1 minus tau in period 2, right? Let's say r is 10%, let's say tau is 30%. Under the original budget constraint, for each dollar you consume in period 1, you're foregoing, right? You're foregoing 1 plus r, right, which is 10% less what. So here, if your original interest rate is r and the tax rate is 30%, each dollar of foregone period 1 consumption nets you $1.07 of period 2 consumption, right? Then we reduce the tax rate on interest income. Let's say we cut it in half. Rho is 0.5. Now each dollar you consume in period 1 is costing you more in terms of period 2 consumption, right? It used to be 1.07, now it's 1.085, right? Everyone see this? Everyone with me? Okay. So the cost of period 1 consumption has effectively gone up, right? Let me say it one more time. Let's do it all together. So if we originally had a rate of interest, if r equals 0.1 and tau equals 0.3 and rho equals 0.5, such that the subsidy to retirement savings is basically a halving of the tax rate, right? Under the original budget constraint, your effective rate of interest is 10% times 0.7, right? So it's 7% is your effective rate of interest, your after-tax return. So each unit of period 1 consumption, so let's say $1 of period 1 consumption, costs you $1.07 in period 2 consumption. Then we start offering the subsidy to retirement savings, which reduces the effective tax rate on interest earnings, and your after-tax rate of return goes from 7% to 8.5%, right? So each dollar of period 1 consumption now costs you $1.08.5, right? $1.085 of period 2 consumption. So now the price of period 1 consumption has gone up. So your period 1 consumption, the substitution effect is going to lead you to consume more or less in period 1? Less. So you're going to save more. Are you poorer or richer? So you're going to kind of consume more in all periods, including period 1, which is going to cause you to save less. So here again, the income effect and substitution effect point in opposite directions, right? But because it's a subsidy, it's the reverse. You're getting richer, and you're increasing the price of period 1 consumption. Does that make sense? Because remember, the slope of the budget constraint is always telling us how the market trades off one good for the other good. In this case, how the interest rate translates period 1 consumption to period 2 consumption. Awesome. Okay. This is some world in which you can get the saving subsidy on every dollar you save, right, of your full income. Is that the way IRAs work? No, right? There's a contribution limit. It's $5,000, it's $3,000, depends on the year, depends on the tax code. But there's a limit to how much savings you can put into your tax-favored account. You can save more than that, but you're not going to get the saving subsidy on that, right? So let's go ahead and model that. That's going to look like this kinked budget constraint, right? Because the blue line is our original budget constraint. This is the non-tax favored account, right? This is like a regular bank account. You're going to get interest at rate R. You're going to pay taxes on that interest earnings at rate tau. So that'll be your slope of your original budget constraint with no tax favored savings vehicle access at all. Then we introduce a tax favored savings vehicle, like an IRA, but it has a contribution limit. In fact, the contribution limit is $3,000. You can save more than $3,000, just not at a tax favored status, right? The rest of that money is going to go into a regular bank account where your interest payments are taxed at rate tau. But for this initial $3,000 piece, you get a tax subsidy so that your effective tax rate falls from tau to tau times rho, where rho is something like a half or something, or a third or something. Okay, so what's that going to do to our budget constraint? Well, for the first $3,000, we raised the rate of return on savings, right? We've raised it from negative 1 plus r times 1 minus tau to negative 1 plus r times 1 minus tau rho, right? We've increased it. But then I said, after you've saved $3,000, the subsidy goes away. The slope from then on is going to just be negative 1 plus r times 1 minus tau. Rho now equals 1, right? There's no longer a discount on the tax paid on interest earnings. So our slope is going to be parallel to the original budget constraint from then on. What is the impact of this savings vehicle that's limited? Well, it's going to have different impacts on different people, right? So if you were a low saver, let's say you were to the right of the kink point E, you're going to look like this, right? You were somewhere at a point somewhere like A. such that you were saving somewhere less than $3,000, you could either save more or you could save less, right? This is just like the old model. Because what have we done? We have increased the opportunity cost of period 1 consumption. That's going to lead to a substitution effect that makes you want to consume less in period 1 and save more, right? At the same time, you're richer. So you want to consume more in all periods, including period 1, which leads you to want to save less. So the net impact is ambiguous. If the substitution effect wins, you're going to go ahead and save more and go to a place like B, right? If the income effect is bigger, you're going to save less and go to a point like A. That's the guys who are affected, right? Whose rate of return on savings, on marginal savings, has increased. What if you were over here? Have we increased the incentive you face to save $1 more than you were? Has your rate of return on your next dollar of savings changed? No, right? Because what's the slope of your new budget constraint if you're somewhere over here? Same as the old one, right? Because remember, economics, when you think about whether people are changing their behavior, it's not average tax rates that matter, right? It's always marginal tax rates. Here are the marginal return to a dollar of savings if you're to the left of E, right, of that king point. If you're in that area, the rate of return on your marginal dollar of savings has not changed. But what has changed? Your income, you're richer, right? The red line lies above the blue line. So let's go ahead and think about a person in that situation. So if you're to the left of the king point, you're now richer. When you're richer, you want to consume more in all periods, including period 1, which will lead you to save less. Okay, so let's take a step back. Let's think about this for a minute. So if you're over here, if you're a low saver, the impact of introducing the savings vehicle is theoretically ambiguous, right? It's unclear whether when we give you the savings subsidy, you'll save more or save less.
The second part you're talking about?
No, these guys.
Okay.
Right? Just like we talked about. So the substitution effect will lead them to want to save, in this case, more because we're giving them a subsidy. The income effect will lead them to want to save less. The net impact is ambiguous for these guys, the low savers. Yep. These guys, it's ambiguous. These guys, we said it's, if anything, they're going to save less, right? Because the income effect leads them to feel richer, so they're going to save less. They're going to consume more in all periods. So the introduction of a savings vehicle, according to this intertemporal choice model, is at best unclear, right, for the low savers, and is for high savers, negative. That's interesting, right? That's not the way these types of things are covered in the media very often, right? Because this is one model, right? This is one way to look at it. This is the traditional kind of standard model. The income effect substitution effect leads us to kind of have an ambiguous idea for the low savers and for the income effect to lead high savers to save less. The way to think about this, right, is that when we talk about these high savers saving less, they're doing two kinds of savings, right? They have two piles of savings. They have a pile of savings that's in the tax favored account. They have a pile of savings that's in some other non-tax favored account, some other regular bank account. When we offer them a bigger subsidy on this savings, the tax-favored savings, they're richer, so they're not going to not contribute to this account. Why would they give up the subsidy, right? What are they going to reduce their savings in? In this account, right? So that the net savings they're doing will be lower. It's not that we'd see them not maxing out their IRA necessarily. It's that maybe their other savings would go down. Okay. So I said that's one model. There are other models as to why people save. Because what was the motivation here? Why were people saving in this model? You save in order to finance period 2 consumption. Here you're trying to consumption smooth across periods of time only, right? It's only the fact that you're going to live in retirement and want to consume then that leads you to save here. It's the fact that you want to transfer income from a period where you have lower marginal utility because you have some consumption to a period that has higher marginal utility where you have no income, right? Because you're going to trade them off. How are you going to decide how much to consume in each period? You move consumption from one period to the other by savings until the marginal utilities are equal, right? That's how you find tangency. That's exactly what that's about. So all you're doing here is kind of consumption smoothing over periods of time. But there are other reasons people save. In fact, if you ask people in a survey why they save, the first thing they'll say is retirement. It's this model, right? The first model. The second thing they say is in order to sort of have some economic cushion or financial cushion against adverse economic events, like losing your job, like there being a tornado in your town. Like getting sick, right? All of those things are adverse economic events, and people build up savings in order to weather those negative shocks. So that model is called the precautionary savings model, where people here are actually also consumption smoothing, but they're not consumption smoothing over periods of time. They're consumption smoothing over what we call states of the world, the bad state of the world and the good state of the world. So has everyone heard the term state of the world before? It's a probability term. Okay, what it means is that, so if in the event, right, is it going to rain tomorrow? There's two states of the world. It rains and it doesn't rain, right? States of the world are sort of outcomes of an uncertainty. So here, in the precautionary savings model, people are trying to consumption smooth over states of the world. The state of the world where they're employed versus the state of the world where they're unemployed. What they do is they save in order to transfer income transfer consumption into the state of the world where they've lost their job, right? So they can consume in that period too, in that period, in that state of the world as well. So uncertainty, right, leads to precautionary savings. You're trying to smooth consumption over future uncertainties, i.e. they save for emergencies. Okay, so this model has a couple implications. The first is that greater uncertainty should lead to more saving. That if there's greater uncertainty about what the future will hold, you will want a bigger cushion of savings to fall back on. Later on, when we talk about insurance in the second half of the course, we'll talk about this kind of situation where you're building up your own stock of cash to sort of protect your consumption against adverse events as self-insurance. It's also called self-insurance. Because you're not going out to the market to buy an insurance contract, you're just saving your own assets to weather bad adverse events, right? To weather negative shocks. Okay, so greater uncertainty leads to higher savings. The second thing is that if we have a bigger social safety net, we'll have less savings, according to this model, right? Because what are you saving against? Adverse events. If the consumption shock of a bad event is smaller, you need to save less, right? So one example would be the introduction of an unemployment insurance system should reduce savings, right? Because people were saving to sort of buffer their consumption against unemployment. But if they know that there is some type of unemployment insurance scheme that they're part of, they don't have to save quite as much for that event. I'm sorry, I get really, really thirsty while teaching. And it's worse this lecture than the first one. It has some like cumulative effect. Okay. Okay, so let's talk about the empirical evidence. So we've talked about this model, so taxes and savings, some empirical estimates. So if you notice, when we talked about labor supply, I got into numbers a lot faster, right? I got into the empirics a little bit quicker. The reason I've held off is that we have a lot less clarity, or a lot less consistency, in empirical estimates of the impact of taxes or subsidies on savings behavior. They range widely. They range from 0 to 0.67. And I could say that there are goodish studies on both sides of that interval, right? It's unclear. I don't know where the number lies. The reason why this is such a difficult question to answer is that the scope for the quasi-experiments with panel data that we kind of like is smaller, right? A few reasons for that. Well, first of all, interest rates, right? One of the main drivers of the change in after-tax interest rates is changes in interest rates. But changes in interest rates don't really affect some groups and not others, right? There is no natural treatment and control group because interest rates tend to change for everybody similarly, right? At least as a percentage change. It seems to be very similar for people. That, we don't really have Alaskan interest rates, right? Capital markets are integrated. People face the same sort of rates of interest for borrowing, and so it's very hard to find treatment and control groups. Second, if we want to look at sort of whether or not you could have contributed to a tax-favored 401k or something like that, there's a lot of individual heterogeneity. Cross-sectional data is really dangerous here because even the people who have the opportunity to save through these tax-favored savings vehicles, like let's say they work for an employer that has a 401k program, people are selecting, some people look at that stuff when they choose a job, right? So people are selecting into even the opportunity to use these vehicles. So there's a lot of sort of cross-sectional danger here. That comparing across people is going to really give us a bias coefficient because the people are just so fundamentally different. Savings behavior is something that people varies across people, and people can select into jobs and into situations based on their sort of preference for savings. And finally, suppose I actually had data. I convinced Fidelity to actually give me this data on all their IRA account holders. During the early 2000s, in 01 and 03, we changed the amount of contribution you could make to your IRAs. We increased the contribution limits. And so that's an experiment, right? There's a policy change. I can see these people's IRA accounts. Suppose I see that, hey, you know what? We increased contribution limits. So the net subsidy to IRAs went up. And we saw a lot more contributions to IRAs. Is that ironclad evidence that tax subsidies to savings increases savings? We increased the subsidy to IRAs. We saw IRA contributions go up. Because I talked, the guys who look like that, right? I said they have two piles of savings. Savings in their IRAs and savings outside of their IRAs, right? They're high savers. They've exceeded the contribution limit. So while I might have data on people's IRAs, I don't have their full portfolio of assets, right? And I can't see what they're changing in their other stockpiles, right? In their other savings accounts. So even if I see the fact that when subsidies to IRAs go up, we see more IRA savings, we don't know what's happened to total savings by that individual. They could simply be moving income from their non-tax favored account into their tax favored account, right? We call that reshuffling. Unless I can see every account you have, I can't tell whether you're doing that or not. So even if Fidelity gave me every account they have for every individual, you might have a bank account, right? You might actually save at Chase. These rates are so low, why would you? But you might, right? You might do that. And so if I can't see your entire sort of set of assets, it's a very hard question for me to get at. Okay, so estimates vary widely, but there have been some recent randomized studies with sort of offering private savings incentives that suggest that lower income people are much more responsive to savings incentives, and that we really can change savings at least for some groups with subsidies. Okay, so we talked about the intertemporal choice model. We've talked about the precautionary savings model. Now let's talk about behavioral studies. So behavioral studies sort of look at quirks in people's behavior, right, and try to uncover heuristics that people use to sort of make decisions. So to back up for a second, in the intertemporal choice model, and even in the precautionary savings model, we made two strong assumptions. We often make these assumptions so they seem a little more normal to us, but that doesn't mean that they're any less strong or heroic. The two assumptions we've made are, first, that individuals have the cognitive ability and financial literacy to calculate how much they actually should be saving, right? That they can sit down and make this calculation every year and figure out what they should be contributing to their various accounts. Second, that even if they can do that calculation, that they have the self-control to actually carry out that decision, right? So the first part is, can they figure it out? The second part is, when they walk past really cute shoes, can they forego cute shoes and contribute to their retirement savings accounts, right? Like, that's the question here. Can both of these conditions be met? Because both of these things have to be true in order for the traditional model to really be operative. A preponderance of research suggests that at least one of these assumptions is violated, right, in various situations. People are not quite as rational as our models often assume. Okay, so ways in which people seem to be acting seemingly irrationally. So people tend to actually ignore savings incentives. So they seem to leave money on the table. Like, there are situations with certain 401k matches, et cetera, that you could do something where you contribute to your so this year, so in a given year, you contribute to your 401k, your employer matches your contribution, and you could actually withdraw it, pay the penalty, and end up better off. And we see people not doing that, right? We see people sort of not doing that. We see people doing funny things like saving in their bank account and carrying credit card debt. Right? You're earning interest even in a money market account, like 2-3%, right? You're paying 19% interest on your credit card. There's money on the table, right? But people seem to be doing these. We see this pattern of behavior quite commonly, right? So that doesn't really follow. That's the leaving money on the table problem. That people aren't really even sort of doing the math and figuring out that they're leaving money on the table. The second thing is that people tend to follow their defaults. For whatever reason, going down to HR and filling out that paperwork to change your default for your retirement account is extremely difficult for people to do. Either HR is really far away, doing the calculation is really hard, or they can't make themselves they can't commit to actually saving what they think they should save, right? Something is going wrong with our model that leads people to really stick with their defaults. Sure, for some people the default could be optimal. It's hard to imagine that it's optimal for the number of people who stick with their default. Okay, that's sort of people ignore savings incentives. And even when people do save, people don't seem to actually invest very wisely into their subsidized accounts. So first of all, there's this 1/n decision-making rule. So if we offer, if your 401k offers you 5 different mutual funds, a lot of people put 20% in each of those funds. If there's a combination of stocks and bonds, people tend to put half their money in each. They tend to take their number of options, divide their assets by that number of options, and put equal amounts into all of these things. There must be people for whom that's optimal. It's hard to believe the 1/n rule is optimal for as many people as sort of follow it, right? People just sort of have difficulty making diversification decisions, and they seem to simply just divide by the number of options and go with that. people don't seem to actually understand risk very well. So we see this own company bias. So even in firms where people don't have strong incentives to buy company stock, right? We see that people own a lot of their own company stock. There's some kind of loyalty, I guess, to it or something, but at the end of the day, in terms of risk, that's not a great decision, right? Because when if your company is hit hard, right, if there's a scandal or just times are tough in your industry, the value of the shares of your firm are likely to go down, and B, you're more likely to be out of a job. You don't want a perfect correlation between your savings and your labor income, right? That seems like a dangerous place to be. But people tend to actually do this. They tend to over-allocate their portfolio towards their own companies. And finally, people seem to actually focus way too much on past returns, right? Try to time the market and stuff. They don't seem to sort of think about sort of outcomes as broadly as they should. Okay, so what if we sort of think that people have these heuristic, if we seem to have uncovered these odd heuristic rules for savings behavior, what policy instruments could we use to sort of help people save more effectively or save more? Well, first of all, there's simply financial literacy education, right? This sounds like a simple idea, right? But it's actually hard to do, right? We don't have this in our high schools. Did anyone get this stuff in high school? No, neither did I. I don't know anyone who did, right? But it's funny. We all got health. I mean, we all have a body. It's good we got health. But this may be something sort of on the level of civics, right? I didn't have civics either, but some of you may have had civics. I think we had government. I guess that's civics, yeah. But if we know what the three branches of the government are, I think we could also probably learn a little bit about how savings accounts work. Maybe, I don't know, that's an idea. And that's sort of one notion, is that better financial literacy education. And I think sometimes people think this is a simple idea or something that, people just say it's a good idea. But I think there are a lot of people who don't get this at home. And I think it could be something that could be effective for some folks at least, right? It's one idea that sort of help people better be able to do the math, right? This is what and understand the system is what financial literacy is about. It's about that first sort of violation of the model. Second, allow a change in the default. So in many jobs, in many employers, 401k programs, the default is a contribution level of 0. What if we change the default to 2% of earnings or whatever it is? Everyone is free to go down to HR and change the default, right? It's entirely optional to you what you want to contribute, but let's default you into saving something. That's something we're actually seeing happen at the policy level now. There's some talk about changing defaults for things. But I think that sometimes sounds like a really sort of simple sort of improvement. What is hard though is suppose we default you into saving to some degree in your 401k. What are we going to then default you into in terms of your portfolio? Right? What's the default portfolio? Is it half stocks and half bonds? Because of the 1 over n rule that we're going to follow, right? Is it 40-60? It depends, is it different for a 25-year-old than a 60-year-old? There is a sort of a responsibility that comes with sort of defaulting people into saving, right? We then have to sort of default them into a saving pattern or an allocation pattern. And that sort of, I think, is part of the problem, right? Your employer can default you, but it's not a controversial decision for him or her to make as to reallocation. Even cash, right? Cash can be a bad investment in certain economic circumstances. If inflation is high, cash could maybe if interest rates are not keeping up with inflation for some reason, or there's various reasons there might be better options. It's still, whatever it is, your employer may not be comfortable choosing your allocation. So defaults are a charming solution to the problem, but I think it's a little more complicated than just sort of saying go with defaults suggests. We could even default people into patterns of contributing more over time, which is another default version. And there's also sort of we can even without defaulting them, it seems like we can get people to agree to certain kinds of savings vehicles that will help them save more over time. The textbook talks about this program called Save More Tomorrow by Richard Thaler. He went into a mid-sized firm and offered people this idea that, you don't have to give up anything today. He wanted them to no, forget it. You can go buy shoes today. You can go do whatever you want. But in the future, when you get a raise, commit to putting part of that raise away, putting it into a savings account. So it helps, people are more willing to do this. They can't give up current consumption, but they're willing to say, don't even put the money in my hands in the future, just put it in a savings account. And that might be an option too, right? That's another idea to sort of address people, take people's behavioral patterns seriously and address them through policy. Let's go back to what existing subsidies look like. And let's talk about the equity implications, the distributional implications. We have some existing subsidies. And when we talk about the distribution of retirement savings subsidies, what we're talking about is, how do people at different points of the income distribution sort of benefit from these subsidies currently? So there are a few reasons why the benefits to retirement subsidies are they benefit those with more income more than those with less income. And there's a few different reasons. So first of all, higher income workers are more likely to work for employers that offer these types of plans, that offer 401ks, that offer retirement programs. They're just more likely. Part of this is that any program like this, anything like a 401k, has administrative costs to it, right? And if you're a big firm, you're dividing those fixed costs over lots of people, so it's cost effective for you to provide that program to your employees. But if you're a very small business, let's say you have 3 employees, those administrative costs are being divided over very few people, and so it's just not it's not worthwhile, right? And just because of sort of the structure of the economy, except for small business owners, people who work for small businesses tend to be lower income than people who work for bigger businesses, right? You could imagine that like a mom and pop store doesn't really have a general counsel, right? The way a corporation would, right? So there's just more higher income jobs in big firms than in little firms. So it tends to be true that higher income workers are more likely to work for employers that offer these types of pension programs. Second, even outside of 401ks, even like a traditional pension, like what auto workers get or what some firms offer, right, where you sort of get a pension from your firm, that's also a tax-favored savings vehicle, right? Because your firm gets to deduct its contributions to your pension account from its corporate earnings when they pay corporate taxes. So that's also tax subsidized. So if a union worker often gets a pension, many firms get pensions, right? Defined benefit or defined contribution pension. Those are also tax-favored sort of retirement savings vehicles. So all of those things are more common at big firms, and higher income workers are more likely to work at big firms. Second, higher income people are more likely to participate in pension plans or IRAs. So even even when offered, higher income more than lower income people tend to participate. Partly this is due to liquidity constraints, right? That people who are lower income just have less income to save, right? That they sort of can't borrow against future income. It's harder for them to make use of these vehicles. So even if everyone has the opportunity to participate, higher income people tend to participate more often. Even if they both participate, higher income people tend to contribute more to these accounts. Again, this is sort of a level of income question probably. And finally, and lastly, these benefits tend to accrue to higher income people more because, what's the initial tax benefit to this? The deductibility of the contribution. And then later on, it's the fact you don't pay interest income taxes, right, on all the accruals. How is all that stuff taxed? You're deducting it from your ordinary income rate stuff, right? What's true of a progressive tax system? Marginal tax rates are higher for higher income people, right? So all of those benefits are worth more to better off people because their marginal tax rates are higher in a progressive tax system. So for all of these reasons, these saving subsidies tend to accrue to the upper end of the income distribution more than the lower end. Notice I say upper or higher, I don't say the top, because a lot of these saving subsidies phase out for really high income individuals. For example, in the case of a traditional IRA, if after a certain level of AGI, it starts how much you can actually contribute to a tax deductible traditional IRA starts to go down. Eventually, it's zero. But even if you're not eligible to participate in a tax-deductible IRA, where you get to deduct your contribution today from your taxable income today, you can actually participate in what's called a non-deductible traditional IRA, where you have to pay the taxes today on what you put into the account, but you don't have to pay taxes on the interest earnings in that account every year. You only pay that at the end. So there is some tax-favored vehicles for even those who are unable to participate in traditional IRAs. I'm sorry, I can't remember your name. Shiraz, yes.
So what would some policy responses be to kind of give the same preferential subsidies to lower, like somebody who works in McDonald's?
Okay, so we'll actually jump ahead. We'll go in order. We'll get to it in a minute. Okay, so before we get there, I want to talk about traditional versus Roth IRAs. So IRAs come in 2 flavors, the first being the traditional, the second being the Roth. So traditional works in the following way. You're going to make a contribution today. You deduct that contribution from your taxable income today. You put the money in the account. You get the interest on the taxes you should have paid when you made the contribution. You get the interest on the accruals as you go, right? You get both of those pieces. At the end, when you retire and you make withdrawals from that account, you pay taxes then. That has a few benefits, right? So it has all the inside buildup, the tax deductibility on the front end. And also there's this final piece that for many people their marginal tax rates at retirement are lower than their marginal tax rates while working. And so you get that additional benefit. There are some, so that's the traditional tax deferred IRA. The second flavor of IRA is the Roth IRA. The Roth IRA is sort of the opposite. You pay your taxes today. So you don't deduct your contributions from your taxable income. You wouldn't pay taxes on it today. You put the money in the account. You don't have to pay taxes as anything accrues, but when you retire and you make withdrawals, you don't pay taxes then. So Roth, you're prepaying the taxes and not paying taxes at the end. Traditional, you're not paying taxes today and you're paying taxes at the end. They're the opposite. So the Roth arose and was expanded. It gives people sort of a different way to structure their retirement savings, but it also has a benefit to the U.S. budget, the way we score it, right? Because with a traditional IRA, the loss of revenue to the government is apparent when? Today or a long time from now? No, the traditional. The loss of revenue. Today, right? When do we get some of the revenue back? When you retire, right? 40 years from now, 30 years from now, long time from now. With a Roth IRA, when do we get the tax revenue? Today. And when do we see the real losses? Like when do we see the lack of revenues? In the future. So let's describe these two time periods in different ways. With the traditional IRA, you see the missing revenue today. You get the revenue when today's senators are no longer senators, right? Given the average age of senators, they may not even be alive by the time you see that revenue, right? While with the Roth IRA, you see the revenues when today's senators are still senators, right? So for the budgetary process that looks at a 10-year budget window, creating the Roth IRA program adds revenue to the Treasury in the 10-year window. On net, do either of these things increase government revenues? No, they're tax subsidies. By definition, we're giving up tax revenue to get people to save, right? So for the purposes of a 10-year budget window, expanding the traditional IRA or creating the traditional IRA puts a big revenue hole in the short term that's somewhat made up in the long term, right? But that long term is many, many elections away. In the Roth IRA situation, we get a little bit of a budgetary a positive impact. We get some revenue today in exchange for larger losses in the long run. So the Roth IRA is, for the 10-year budget window, a source of revenue. So the book talks about this. When a tax cut was passed in the 2000s, in the early 2000s, it was slightly, they were trying to pass a tax cut that was a little too expensive, right? Or there was a program that was a little too expensive relative to what they wanted the budget target to be. So they paid for that tax cut by expanding the Roth IRA eligibility. They paid for one tax cut with another tax cut, right? In the actual US budget, that makes no sense. But when you only use a 10-year window, it works. It works. So yeah, that's the story there. So one of the things you can think about, so with the traditional IRA, you pay taxes when you're old. With the Roth IRA, you pay the taxes when you're young. If you think there is legislative uncertainty about tax rates, right? We're all kind of young. We think that, we've seen the deficits, we've seen the debt. The odds that we're really going to pay that down without increasing tax rates, maybe it'll happen. Maybe we'll cut spending enough. Maybe we'll do it. If we were betting people, we'd say that there is some probability that tax rates are going up in the future, right? In the long future, that is our future. That is our retirement future, right? Oh, one second, I'll get to you. So one thing you could think about doing is to diversify your tax rate risk, right? Whether your tax rate at retirement will be higher or lower than today is partly affected by this legislative uncertainty. You could open one of each and contribute part of your contribution limit to each of them and diversify sort of your tax rate risk by contributing to both. The rules for the two of them are a little bit different, but there's ways around them too. Question?
With the Roth IRA, you pay taxes on the contributions now. How about the interest that you earn?
You get that tax-free. You get the inside, the accrual, the taxes on accruals every year. That's tax-free for both of them until the end, in the case of the traditional. But good question. Yes. So I do want to say, as I think that was a great question. I'm happy to answer. There's a certain line at which we're talking like economic understanding of tax policy versus tax planning by a tax lawyer. That line, I don't know that much about it. I can't optimize your taxes. Lord knows I probably don't optimize mine, right? So that's just not something I know a ton about, especially when we get to really sort of small administrative details of the tax code. Your guess is as good as mine. Your Googling is just as good as mine. So yes, there's a point at which it's not really economics anymore, and I'll let you know. Feel free to ask all questions. I'll just let you know when it's sort of tax law or tax planning rather than tax economics. Okay, so this explains the fact that, I said in both these cases, you're either paying taxes today in the Roth. This is a traditional IRA setup where you're paying taxes in the future. This explains where the tax subsidy comes from. We've already talked about this, right? It comes from two things. It comes from the fact that you get the interest on the taxes you would have otherwise paid on the contribution. And second, you don't have to pay taxes every period on the interest that's building up in that account. That's the source of the subsidy. It's nothing complicated. What's amazing is the power of it. So sometime when you're bored or you have like a little cousin or something or a little brother or sister who, you're trying to encourage them to understand the power of compound interest. Okay, maybe not everyone is doing this with small children, but it would be good for the country if you did. Be patriotic. So at some point, maybe it's for you, I don't know. I still find it alarming. Like, a small interest rate difference over 30, 40 years, you come out with very different amounts of money, right? And those small differences are literally the tax subsidy of retirement savings in some cases. Maxing out your this is my pitch for your future. Maxing out your IRA contributions every year is probably one of the best things you can do with your money. The tax subsidy is real, and it's substantial. For that level of savings, you'll come out with very different amounts of money. Whether you do it for, whether you max it out or not, you'll end up in very different situations 30, 40 years down the line. You're young. You have decades. Okay, moving on. So going back to Shiraz's question about what we could do to help people sort of on the lower end of the income scale, how we can sort of if we have all these tax subsidies right now, but they really accrue to people on the upper end, or the middle, sort of the upper middle of the income spectrum, how can we help people lower down, right? One of the things introduced was called the Savers Credit. The Savers Credit was enacted in 2001, and it was a savings incentive for low and moderate income Americans. So taxpayers can basically receive a tax credit for contributions to retirement savings plans. It really only targets low and moderate income people. Higher income people are not, or even like upper middle are not really eligible for this. The maximum amount of savings that is eligible for the credit is $2,000, and it's structured in the following way. It's a 50% credit rate for AGIs less than $16,750, 20% for the next bracket, and then if you're below $27,750, you get 10% in that last piece. So as you can see, it's not really high levels of AGI, right? It's at best moderate income people. Remember, AGI is not income, right? It's modified, it's adjusted gross income. So, these are people earning more in salary than this, but it's not really high up on the scale, and it disappears fairly quickly, right? But the thing about this that actually makes, it does help people sort of save, right? It definitely offers a tax offset for saving. But the thing is, it's not refundable, and which limits its scope to help those really on the low end of the income distribution, because there are a lot of programs, right, that sort of general credits for children, for having children, the standard deduction, the personal exemption, all those things sort of lead people with very low levels of AGI to actually not even be paying taxes at the end of the day. And so, this is a trade-off, right? We could help them save more, but we'd basically be giving them the money that they're using to save. Right, so it's sort of it's a policy question, and right now our policy choices have been to have the savers credit but not make it refundable. Okay. So that actually gets back. That sort of ties into private versus total savings, right? Private versus national savings. What was one of the main goals of? So there were a couple goals for subsidizing retirement savings. One is to help people actually save for the retirement so they have enough income to consume when they're old. Right? The second part was to encourage capital formation, so the U.S. economy has more capital to work with. Capital formation in the U.S. is a function of national savings, right? It's also a function of foreign investment, but we'll put that aside until the deficits and debt lecture. But so let's just say one of the main drivers of sort of capital in the U.S. is national savings. So that's the net of private savings and public saving, right? Where public saving is the saving the government is doing. In this case, and today, what are we doing? We're doing anti-saving, right? We are spending more than we take in. The public saving is negative, and there's private savings, and that's net savings. If for every dollar of tax subsidy we're sending out, we are not generating a net new dollar of savings, we're reducing national savings by subsidizing retirement savings, right? Because each dollar of tax subsidy we send out, or each dollar of tax revenue we forgo to subsidize retirement savings, is $1 less of national savings. Unless we're generating $1 of private savings, we're in a net loss situation. And the question as to how effectively we're getting national savings for each dollar of tax revenue we are foregoing is a question of inframarginal versus marginal effects. If we're mostly subsidizing savings that would have happened anyway, right? If we're talking about guys who looked like these guys, if most of our tax subsidy dollars are going to guys like this, we're not going to increase national savings, right? Even if these guys left there, even if this guy didn't reduce his savings, suppose somehow he saved the same amount, we'd still be transferring dollars from the public coffers we'd be giving back tax dollars, right? And that's going to reduce public savings and not necessarily increase, or in this case, decrease private savings. Okay, so let's go back to the story. Okay, so this is a case where if the inframarginal effect is bigger than the marginal effect, we're going to reduce national savings, not increase it, by actually having savings vehicles. Let's go through an example. It's a very simple example. Let's imagine we're just talking about like an island economy, right? There's like one person in it. So let's imagine that if we offered no subsidies for savings, so no IRA, the total amount of income in the economy would be $150, $100 of which would be saved, $50 would be spent on would be sent in tax revenue, would be tax revenue. Imagine it was true that if we introduce a savings subsidy program, we would increase private savings by $25. Okay, so in that case, savings is $125. We're giving people so taxes paid falls to zero, right? So how much has savings gone up in the private part of the economy? $25. How much has public savings fallen? $50. So the introduction of this savings program in this simple example has actually led to a decrease in national savings. And this is because the foregone tax revenue used to incentivize savings generates less than an equal amount of new savings, right? Some of that's just going to period one consumption. Any questions about this? So is this always true? We don't know. We need an estimate of what the what the elasticity of savings is with respect to tax rates to really know. But it's theoretically possible that subsidizing savings could actually lead to a net loss of national savings because each dollar of foregone tax revenue is generating less than a dollar of new private saving. Okay. That's sort of the end of talking about models. No more diagrams. Okay, so that's the end of sort of choices about retirement savings and consumption and trade-offs. Now we're going to talk about capital gains taxes, and we're going to end talking about estate taxes.
I'm sorry, one question. So in order for in this example, you need to save at least under the IRA, the gross income should at least be 200 in order to break even.
You needed to be generating $50 in new savings in order to break even.
Oh.
Does that make sense? Okay, so capital gains taxation. Okay, so assets come in two varieties, right? There's things like bonds and savings accounts that pay interest every period, and that interest income is taxed like ordinary income, just like labor income. There's another kind of asset variety where the returns come in capital gains, right? Imagine a stock that doesn't pay dividends. So dividends are taxed like, well, it depends. Let's not talk about dividends today. We'll talk about dividends when we talk about corporate taxes. Some dividends are taxed like ordinary income. If the corporate tax has not been paid on those dividends, if the corporate tax has been paid by that corporation, they're taxed like capital gains. Simple story. Okay, so there are also assets that their main return comes from changes in their value, right? That could be a stock that doesn't pay dividends, where you buy at 30, you sell at 60. The capital gain is the difference, is the $30 difference. That could be a painting that you bought for $1,000 and you sell for $40,000, right? Those are all capital gains. The return to that asset comes upon sort of selling it. So while interest and dividends are taxed as they accrue, so as you get interest payments from holding a bond, or you get dividend payments from holding a stock, it's taxed that year as you accrue that income. Capital gains, on the other hand, build up over time, right? So stock prices change every year, you're gaining value every year, but we don't tax that increase in asset value until you actually sell that stock or until you sell that painting. It's only upon realization do we tax capital gains. That's sort of for a practical reason, right? Because, well, you could imagine sort of taxing changes in stock values, like we can see what stock values are every year. Doing that for a painting would be hard. We'd have to have an appraiser come out and value your painting every year, and some years we'd be giving you money back, and et cetera, et cetera. Also, if there is volatility, right? Even in the case of a stock where we could see prices every year, suppose your stock triples. Unless you sell some of that, you can't really finance the tax owed, right? So, there's also difficulties of financing it and also the volatile amount, right, would be back and forth. You'd be transferring money from the government to the government each year. All of these things make taxing capital gains annually very difficult. So we just tax them upon realization when they're sold. The way we sort of tax capital gains is there's a capital gains tax rate, and it's applied to the capital gains tax base. For many assets, that's the difference between the purchase price or sorry, the selling price and the purchase price. So you bought it at 10, you sell it at 100. The tax base for the capital gains tax is $90. But there are cases where the basis is different than the purchase price. This amount that we subtract from the sale price is called the basis. What we subtract from the selling price is the basis. For most assets, it is the purchase price, but in a special case, it's different. And we'll talk about that special case later on in this lecture. Okay. So in the US, capital gains are tax preferred. They're tax preferred relative to interest payments, right, and dividends that are non-qualified, because non-qualified dividends and interest payments are taxed like ordinary income. We talked about dividends a little bit when we talked about the Romney returns. If you remember, there's two kinds of dividends he had, right? There were tax-favored dividends and non-tax-favored dividends. Non-tax-favored dividends are taxed with regular income. But capital gains are tax-favored. These special rates only apply to what's called long-term gains, so gains on assets that are held for at least 1 year. So if you're a day trader, those increases in value aren't tax-favored. That's just ordinary income to you. So for the first, if you're in the first two tax brackets, if your marginal tax rate on ordinary income is 10% or 15%, you actually owe nothing on your capital gains. It's a 0% rate. If you're in any of the top 4 brackets, so starting with the 25% bracket, 25, 28, 33, 35, any of those marginal tax rate brackets, your capital gains tax rate is 15%. So it's substantially lower than your marginal tax rate on ordinary income, at least 10 percentage points lower. So again, there are several tax preferences, right? First is that it's a lower rate to begin with. Second, when do you have to pay your taxes on capital gains? Only upon realization, right? So if suppose your painting goes up in value in the first year you hold it, it doesn't change in value, let's say, over the next 10 years, but you sell it 10 years later, the tax payment you make 11 years after buying it rather than 1 year after buying it is less in PDV terms than if you'd made it after the 1 year increase in value, right? So the fact that you pay upon realization and not accrual, because of the time value of money, reduces the taxes owed on capital gains. That make sense to everybody? Okay. Third, there's a housing exemption. It's up to $500,000 for a couple that's married filing jointly. You don't owe capital gains taxes on up to $500,000 of capital gains on a home you sell if it was your primary residence when you sold it. Next comes this. This is a phrase I'd like for you guys to be familiar with when you leave here. It's called step-up basis at death. So, suppose an individual had a painting, right, and they had bought it for $1,000. It was worth $100,000. They're dying. So this entire conversation we're going to talk about financial transactions that happen the day before you die and the day after someone dies. I understand most people don't make financial transactions immediately before or after death. But for today, we're going to talk about it in this way, right? It's a little crude, but it's just to keep the asset value the same. Okay, so if this person had this painting, they bought it for $1,000, and let's say it was worth $100,000 the day before they died. If they had sold that painting, they would owe capital gains taxes on $99,000, right? Because the basis for him or her would be the purchase price. So it's the price they sell it at minus the basis. In their case, the purchase price is the basis. So they would owe capital gains taxes on $99,000. So suppose they die. The next day, let's say the value of the painting has not changed at all. Their inheritor, their son or daughter, say, now owns the painting. The capital gains tax base on that painting is not $99,000. It's 0. Because one of the pieces of sort of asset transfer is when someone dies, you get the automatic step up of basis. The basis goes from the purchase price to the price at the time of transfer. So the basis on that painting goes from $1,000 to $100,000. So the capital gains tax base goes from $99,000 to $0. There's a practical reason behind this, right? So when you inherit something, it's very hard for you to know what the original owner paid for that thing, right? You have to go look through documents. They may not be good records. Things have been owned for a long time. There was worse record keeping back then. Even something like a stock. People lose their certificates. They may have the certificate, but they may not have the receipt as to what they paid for it back in the day, right? Great-grandpa's share of Ford, you may not know what he actually paid. You may not have a piece of paper for it. All of this makes sort of actually keeping the basis intact as the purchase price very difficult to do. It's even harder to do for stuff that isn't really traded a lot, right? It's suppose it's been passed through the family for many years or through many generations. God knows what the original purchase price was, right? So for all of these reasons, step-up basis of death is for administrative simplicity in some ways. It also avoids the double taxation of estates that are subject to the estate tax. That's the other piece of it. Okay, so there's a tax advantage to capital gains that comes from the step-up of basis at death. Finally, there is one sort of lack of preference. There is a cap on how much other kinds of income you can offset with capital gains losses. You can offset, if you lose income in a business that you run, you can offset other kinds of income with those losses. Capital gains losses can only offset other kinds of income up to $3,000. So within capital gains, you can offset gains with unlimited amounts of losses, right? Suppose you made $200,000 in gains one year, but you lost $100,000 in investments in that same year, your net capital gain is $100,000, right? And you can use that full $100,000 of losses. The question is, suppose your net capital gain is negative. Let's imagine you had $100,000 in capital gains and $200,000 in capital losses. Not a good year for you. So you have a net capital gain, or actually a net capital loss of negative $100,000, right? You can only offset up to $3,000 of other kinds of income with that net capital loss. So, unlike some other pieces of your income, your income portfolio, there's a cap on how much on the loss offset of other kinds of income. It's unlimited within capital gains, but to offset other kinds of income, it's subject to a limit of $3,000. Okay, so there's a lot of arguments for and against the capital gains tax preference. So by the way, today is a great day to be talking about this, right? Taxes are in the news today. This is like a hot day. I'm sure you're excited and really looking forward to talking about all of this with your friends and family, right, tonight, as soon as you go home. So let's talk about, why should gains be tax preferred, right? So they're currently tax preferred. Everyone running for president now plans to keep the tax preference in place, right? They don't plan to raise capital gains taxes to the same as ordinary income rates. No one is talking about that. Some guys are talking about bringing it up a little. Some people are talking about bringing it down for some people who are lower down the income distribution. There's arguments about exactly how much lower than ordinary income rates it should be, but no one is talking about bringing these rates up to ordinary income rates, right? That's not part of the conversation. These tax preferences are sort of, not so controversial when it comes to people running for office. What are the arguments for these capital gains preferences? Well, one of the arguments is that, when you own an asset for a long period of time, and we tax you on the difference between the selling price and the purchase price, or the basis, right? The selling price and the basis, we're not factoring in the fact that a dollar is worth less today than it was when you bought this thing, right? There's inflation. So we're going to suppose, in the case of the painting you bought for $1,000, that's now worth $100,000. We're going to tax you on $99,000, a base of $99,000, regardless of the fact that $100,000 is worth a lot less today than it was in the past, right? There's been inflation, and we're basically taxing you on the inflation, right? $1,000 from 60 years ago is worth a lot more, is more than $1,000 today. The basis should be brought up into today's dollars, and you should be taxed on the difference in real dollars, right? That would be the way to do it. You'd inflate the $1,000 purchase price to today's dollars, subtract that amount from $100,000, it would surely be less than $99,000, you'd be taxed on that base instead. Everyone follow me? Inflation? Okay. We don't do that. We tax you on the nominal difference between the selling price and the purchase price. And that's kind of unfair, right? We're overtaxing capital gains. So one argument for the tax favored status of capital gains is that, these guys are really being taxed on inflation, and that's not really fair. I think that's a really sympathetic notion that, you're being taxed on inflation, but the fix for that is not to have a random rate of 15 or 20%. It's to do what? To address this concern, to inflate the basis so that it's in today's dollars, right? And then tax you on the base in today's dollars. There's a simple and straightforward fix to this problem. It does not involve an arbitrary uniform rate that's lower, that's 15 or 20%, right? That argument is not particularly compelling as an argument for current policy. It's certainly a concern to address, but current policy doesn't seem to be the best way to address it. The second argument that is initially actually pretty compelling is that we promote efficiency by actually having a lower capital gains rate. Because one of the things that people are tempted to do is that if they sort of experience a capital gain, if they just hold on to the asset and don't sell it today and sell it in the future, they reduce their tax liability. How do they do that? Taxes paid in the future are worth less than taxes paid today, right? So there's this tax incentive to just suppose your painting goes up in value, it's going to be in that value range for a while. You have an incentive to not sell it today and pay the taxes, but to just own the painting for another decade or two and sell it then, right? We call this lock-in. And lock-in is costly because part of the beauty of well-functioning capital markets is the rapid and easy movement of capital from less productive uses to more productive uses, right? You move your capital, you move your income, you move your investments from lower performing stocks to higher performing stocks. You invest in businesses that you think are going to grow. You lend your buddy who's starting a restaurant money rather than putting it in a bank account, right? It's the free movement of capital to its most useful place that actually sort of is the beauty and strength of capital markets. If people are locked into assets, that's a drain, that's a drag on the economy, right? Because you are stuck owning this painting, or you're owning this painting kind of indefinitely because you want to reduce your tax payment, when you really should be investing in a small business, or investing in GE, or investing in something that's more productive than owning this thing to you, right? So you worry about lock-in. This is a really good theoretical idea, right? But it turns out that while this is pretty interesting and compelling as a theoretical idea, the empirical evidence is oddly not there. You know, I was really shocked when I saw this graph. I mean, this graph blew me away. So let me tell you the story behind this graph. So this graph, you know, we have time across the x-axis, and what's plotted across on the y is the realized level of capital gains. So these are realizations of capital gains in every year. This is not the accrual of capital gains, right? This is not how much the Dow has gone up this year. This is when people sell stuff, how much was the total capital gains in the economy that year, right? Okay, so this is realized capital gains. We're cruising along. In 86, the Tax Reform Act of 1986 is introduced, right, and it passes. The Tax Reform Act of 1986 announced that in 1987, effective capital gains rates were going to go up. You used to be able to exclude a bunch of your capital gains from taxation prior to the 86 Act. It said, no more of that. All capital gains are going to be subject to the tax. So the effective tax rate on capital gains was about to go up in 87. What did people do in 86 after this law passed? Sold their capital gains, right? Because it was sort of like telling the American public that, guess what, capital gains are on sale today. They're on sale for the rest of this year. Next year, the prices are going up. So people went in and cashed out their capital gains. So we see this big uptick in realizations. That seems logical, right? Capital gains rates are going up. People are gonna want to sell when capital gains are still low. That seems like an argument in favor of the fact that high rates, that capital gains tax rates cause lock-in, right? But then what do we see in 1987? In 1987, I told you that the effective tax rate on capital gains had gone up relative to 1985, right? What's the level of capital gains like? Is it very different than 1985? On the two sides of the spike are pretty close, right? Right? That's kind of interesting. That's telling me that when effective capital gains rates were substantially higher in 87 than they were in 85, we did not see a lower amount of realizations in 87 than we did in 85. We would really think that in 87 we would see a lot fewer realizations. A, because rates are higher, right? Effective rates are. B, capital gains are not like income. They're not like labor income. Because every year you decide how much to work and you earn labor income that year, right? Capital gains are a stockpile. Because these are realizations of capital gains. So we all have gains in our lives, right? We all have, many investors have an investment portfolio, and they have capital gains in that portfolio, and every year they decide to sell some fraction of that portfolio and realize those gains. The amount of gains in the economy does grow and change, but a lot of it is sort of a stock. It's built up over time. If all these guys cashed out their capital gains, the level of capital gains that are unrealized in the economy should be lower, right? These guys benched and sold a bunch of stuff to pay the lower rate. The amount of capital gains available for realization were lower in 1987 than they were in 1985, right? Because we sort of used up a bunch of them. Even with that fact, and the fact that effective capital gains rates were lower in 87, we don't see a different level of realizations here. And so I, found this argument compelling until I really saw this chart. This is a situation where time series evidence is actually pretty compelling, right? Is it ironclad? No, it's not ironclad. It is, I find it somewhat persuasive though. So it doesn't seem like the lock-in effect has that much of an observable impact when we look at it in time series data. So that's not a great argument. But I will say one thing is that one of the things it might do is having a lower rate in capital gains might sort of help us with border issues with capital flowing out of the U.S. We have a residential tax system, so if you live here, if you're an American citizen, you owe taxes to this country regardless of where you invest. But the combination of offshore accounts and all this stuff, on net having a lower tax rate here at home might keep some additional income in the U.S. rather than flowing abroad. That's the one part of that I do find persuasive. Finally, the final reason to sort of have lower tax rates on capital gains is to promote entrepreneurship. So while it's kind of a meme that small business is the engine of the American economy, yada, yada, it's not really true, right? Small businesses create a lot of jobs, they also destroy a lot of jobs. It's just small businesses come up and they disappear, right? The kinds of businesses that create jobs start off as small businesses. The kinds of businesses that create jobs are young businesses. Google was once a small business, right? There was a day in which Google was a small business. So was Microsoft, and so was Apple. These are all small businesses once. It's small, young companies that create jobs because some of them eventually become big corporations. That's where job creation comes from. But even if every small business is not a job font, right? We do want to encourage entrepreneurship. Because if someone didn't go out and quit their job in Silicon Valley and start Google, we would have no way to know anything right now, right? I'm kidding, no, we would have books. But we would not be able to settle debates out on our iPhones. Went out. So we would live in a much poorer world without someone starting Google, right? The same would be true for Microsoft. The same would be true for Apple. The same would be true for GM. We want to encourage entrepreneurship because that's where innovation comes from. It's where economic growth comes from. So entrepreneurship is a good thing. We want to promote it. One of the main sources of income for entrepreneurs is not the salary they pay themselves every year. It's the change in the value of their firm, right, over time. It's the real return to entrepreneurship. Facebook was once worth nothing, right? The gain of Mark Zuckerberg's wealth, right, did not come from the salaries he paid himself. It came from the change in the value of Facebook as a corporation. So capital gains rates really affect the returns to entrepreneurship, right? That's a real piece of the story. It turns out that most capital gains don't really go to entrepreneurs. They go to just sort of regular investors. But I think this is one piece of it that does have some merit. We'll talk about this more later. That's sort of me talking about this like I'm a media person, like I'm a journalist, because it turns out in the actual model, the effect of taxation on risk-taking is actually theoretically ambiguous. It's actually theoretically ambiguous, and we'll talk about why that is next lecture. But I think this is the most compelling of all of them, and then there's something about borders and keeping money at home. I think there are good arguments for this. A lot of the arguments that are trotted out are not as persuasive as they initially seem, though, especially the inflation one. I mean, that to me is like, why don't we just fix this? Why don't we just actually do this, right? We can just inflate stuff. It'll be easy. But no, we don't do it that way. Shiraz.
When you say it's theoretically ambiguous, does that mean that there isn't a lot of empirical evidence?
No, I mean, it's theoretically ambiguous.
Okay.
And we'll talk about why. We'll talk about it, but basically, the short story of it is that when we tax the returns to risk-taking, it's like the government is an equity holder in your risk. They're taking part of your bet away from you. And the way you're going to undo the fact that you have to share your gamble with the government is you're going to go double down. You're going to go increase your gamble so that your share of the gamble is untouched by the fact it's taxed. That model sort of has certain assumptions to it that may be less than realistic. So it's theoretically ambiguous in the model. There are some parts of that that are less sort of realistic, which could complicate the story and make this more true. So we'll talk about that stuff next week. Other questions? Yep, I'm sorry, I don't know your name.
Libby,
Libby, yes.
what is the second under promotes the efficiency of capital, the second bullet point?
Okay, so what this is saying is that it's sort of this graph, right? In the short run, there is this elasticity to capital gains realizations when it comes to the tax rate. But in the long run, we don't really see, well, I guess what this is saying is we see these realizations, people start cashing out their capital gains. We're not actually seeing people accrue more gains in the long run. We're not seeing people invest more and accrue more gains. It's sort of a short-run response and not a long-run response. The total amount of gains being realized in the long run is not changing. It's only in the short run. If we saw a real change in investment behavior, the long run, the total amount of gains being accrued or being realized should go up, right? Over a 10-year period, it should be going up if we're really changing investment patterns. Does that make sense? Good question. Okay. There are some reasons to sort of worry or be concerned about the tax preferences for capital gains. So for whatever reason, in the US economy, capital gains are highly concentrated at the top of the distribution. They're very concentrated among the 10%, relative to the 92nd percent to the 90th percent. They're very concentrated in the top 1%. And the top 1%, they're very concentrated in the top 0.1% relative to the 9/10. It's like fractals, right? As you go up, it's just equally concentrated. Having capital gains is almost like a tag for being high income. In the sense, suppose really high income people all wore green hats. Every day they wore a green hat. A really good progressive tax would be to tax green hats, right? If only they wore them and they wore them all the time. It would be like green hat tax. That's the new solution to the budget deficit, right? Capital gains are almost like that. They're almost exclusively held by the well-off. And even if people lower down have some, the vast majority are held by the top. The vast majority are highly concentrated. So it's a tag of being at the top of the income distribution. So that's one reason, right? It's a good way to increase the progressivity of the tax code, is having high taxes on capital gains, or reducing the preferences of capital gains would improve the progressivity of the tax code. Having tax preferences for capital gains does violate our notion of horizontal equity, in the sense of, whether how long you choose to hold the stock, right, affects your tax rate, whether it's less than 1 year or over 1 year. Whether you choose to buy bonds or equities changes your tax obligation on that return, right? There's a horizontal equity problem with having this tax preference. It could distort economic choices, right? Because you have a tax benefit from holding some kinds of assets over others, or holding them for different periods of time. We could be distorting people's allocation decisions. And finally, it is somewhat costly to administer this tax preference in the following sense. So if we have a tax preference for capital gains, we create an incentive for people to make non-capital gains look like capital gains, right? Because they can enjoy the tax preference. We see that right now, right, in this city. Anyone know what I'm talking about? When people, well, some of it really is capital gains, but there's an argument about some people getting part of their compensation as capital gains when it's really labor income. It's called carried interest. Anyone heard of this? So there's the idea that part of the compensation in some fields is instead of being paid in labor income, you're being paid in sort of something that can be taxed as capital gains. Some of it might actually be capital gains, right? This could also be true of something like stock options, right? You're taxed as capital gains on some of that stuff. The question is this an investment that you've chosen to make? Or is this compensation for labor that you've supplied, right? And if it's an investment that you've made as part of is in some way, then taxing it as capital gains is fine, right? The question is sort of if it is just really labor income being labeled in a way that makes it capital gains tax eligible, it's not even is it fair, let's not even go there. It's that there are people being employed, right? Lawyers being employed, financiers being employed to basically convert what is higher tax income into lower tax income. And that's that's a waste of society's resources as well, right? That lawyer who's creating carried interest rules, right? Who's structuring contracts, such that the carried interest works on that contract, or the lawyer who's structuring benefit packages such that stock options are a bigger part of it, that lawyer should be doing something else, right? That lawyer should be doing something productive and not sort of spending their time on tax arbitrage. Not in a moral sense, just in an economic sense, right? Because any resources spent on either tax compliance includes sort of tax avoidance, right? That's part of tax compliance, or in tax administration is a waste of resources, right? It doesn't actually produce anything in the economy, and thus it's part of the excess burden of taxation. Does that make sense? Yeah. Okay, so that's the other reason we worry about it's not just capital gains. This is true for any situation where there's different tax levels for kinds of income, that there is some margin of relabeling, right? That you could somehow move one income stream to the other. Okay. So this is a chart that tracks the benefits of lower tax rates on long-term capital gains. This is versus current law. So the Bush tax cuts are supposed to expire, right? And if that happens, so exactly as the law is laid out today, for 2013. This comes from the Tax Policy Center's website, a fun place to spend some time. Okay, so let's take a look at this. Let's look at the second column. So we have cash income levels in thousands of dollars. Let's look at the second column. Percent of returns with the tax benefit. Actually, let's look at the third column. Benefit as a percent of after-tax income. This is how the tax benefits of preferences for capital gains is distributed among people at different parts of the income distribution. What do you see? What is that? What do most? So as we go down, it's higher at the top. It's in fact zero for a lot of that distribution, right? And that's again, it's not because we've structured the incentives such that only the people at the top benefit. It's just that they have the capital gains. Capital gains are really, really concentrated at the top. In fact, these guys up here are getting 4.7, right? That's the category at more than $1 million of cash income. Versus, let's say, someone at the $75,000 to $100,000 range, they are benefiting, right? This is the thing. Capital gains tax preferences do benefit upper middle and middle income people. It's just that the benefits disproportionately accrue to the top. This isn't a story where only the rich benefit. That isn't true at all. Many people benefit. The benefits are just larger the higher up the income distribution you go. And this is why, there are proposals. I think Mr. Romney came out with a proposal to sort of allow people with less than $200,000 in AGI to not pay taxes on their investment income, right? The idea is to sort of move some of these benefits to the middle of the income distribution, right? Is to sort of enhance the tax preferences for those who are not maybe already enjoying a lot of them, but maybe could enjoy more, right? That if we excluded taxes, these people would benefit in the middle more. And the idea of capping it at $200,000 of AGI is so that we're not sort of transferring, we're not sort of, we have deficits, right? We don't have unlimited abilities to subsidize things, and maybe we're going to limit that and target that to middle-income folks is the idea. So that's sort of the notion behind that, is to look at this distribution and see, how that would apply. Okay. So finally, let's going to talk about transfer taxes. So transfer taxes, I'm not going to spend too long on this, partly because I don't find them that interesting, and I don't think you do either. In the sense that these are facts, right? There's not a lot of economics that I'm going to explain to you. These are facts that you can read as well as I can talk about them. So we're going to go through this pretty quickly, because I think if it doesn't involve like real economics, it's not worth our time. I think we're better off spending time on the hard stuff. Okay, so transfer taxes. These are taxes on the transfer of assets from one person to another. This comes in two forms. There's estate taxes and there's gift taxes. In the US, these taxes are unified. The gift tax and the estate tax are combined together. So gifts are assets given by one living person to another living person. Estates are assets transferred from a dead person to a living person. That's the distinction. We have a united tax in the sense that as you give away money through your lifetime in the form of gifts, that is netted against your estate tax, right? So not all gifts are taxable. You can give people a gift up to $13,000 a year and not pay a gift tax on it. But once you get to $13,000, you start triggering the gift tax. So as you give away money through your lifetime, let's say this is a person with a $14 million estate. Through their lifetime, they've given away at $13,000 a pop. They have lots of grandkids, and they like their doorman or whatever it is. They've given away $4 million and $13,000 in increments of $13,000 or more through their lifetime. How does this work? And then they die with a $10 million asset, $10 million estate. The way this works is that as you sort of give these gifts out to people, you have to report them to the government. And that's added up, right, over your lifetime. And then when you pass your estate on, hang on, let me show you. So in 2011, so the estate tax works in the following way. You pass an estate on, right? Everyone gets a certain level of exemption. You don't owe any estate taxes today on an estate that's smaller than $5 million. On every dollar above $5 million, you owe 35 cents on every dollar of estate that you transfer over $5 million. So the way it works is your gift amounts are added up over your lifetime. That cumulative total is subtracted from your exemption amount, right? Because you don't pay gift taxes when you're alive and giving this money away until you get to $5 million, right? Because you're allowed $5 million of transfers tax-free. Suppose this guy made, let's say he had a total theoretical estate of $14 million. Through his lifetime, he made $4 million of gifts. When he dies with a $10 million estate. He doesn't get a $5 million exemption. He only gets a $1 million exemption because he's already used up $4 million of his $5 million exemption through gifts. See it? Get it? That's why we call it a unified tax. Your gifts are netted against your estate. Make sense? Okay, let's go back. Okay, so we tax gifts and estates. We tax at the level of the giver, right? So if I take my $10 million estate and give $1 to 10 million people, I face the same tax as if I gave my $10 million estate to 2 people. We tax it at the level of the estate, not on the level of the inheritance. Some countries tax inheritances, right? So if you divide your estate up over more people, the total tax on that estate is lower because there's sort of less of a concentration of wealth, and they just sort of decide to tax inheritances rather than estates. Okay, so what are the tax preferences for gifts? Well, gifts are actually tax preferred relative to estates. This is the only tricky thing I really want to go through with you. So even though they're taxed at the same rate, gifts are tax preferred over estates for the following reason. Suppose so when you want to make a transfer of an estate, the estate goes to the inheritors and the whole estate is taxed. While a gift is only taxed at the after-tax amount the person gets to hand. So if you give someone $100,000, taxes are owed, right, on $87,000 of that is above the $13,000 exemption. Taxes are owed, right, on the amount that they get, on the $87,000 they get. If I'm the giver, I'm still alive. I can pay the tax. The key to a gift is that the giver is still alive, as opposed to an estate where the whole thing is transferred, right? So in that sense, the tax is levied only on the transfer, right? In the gift, it's only the after-tax transfer. That's the base for the tax. In the case of the estate, it's the full amount. It's the pre-tax amount. So let's go through a concrete example. Oh, sorry. Let's go through. We'll get to the rest of this. Let's do it. This is the last practice problem. Tom has a $12 million estate. We're going to actually do it together. You don't have to do it on your own. We're going to work it through together. Sorry, because I think the best way for me to explain the tax preference for gifts over estates is to actually do this problem with you. So Tom has a $12 million estate that he wants to pass on to his kids. Estates and gifts are taxed at the same rate of 50%. How much would they get? How much would his kids get if he gave them his money the day before he died as a gift versus he died and they get it as an estate? Again, we're always talking about financial transactions right around death, right? Okay, so suppose he gave it to them as an estate. He gave his $12 million estate to them. Imagine there's no exemptions, 0 exemptions. What would be the taxes owed on a $12 million estate if the estate tax rate is 50%? $6 million, right? So what would the kids get in total, in aggregate? $6 million. Suppose instead he did something different. The day before he dies, he instead gives his kids $8 million. What is the tax owed on an $8 million gift? Which is, what does he still have in his account if he's given his kids $8 million? How much is he able to, he'll pay the tax. How much is he able to give his kids in that situation? $8 million. Versus what could he give them if he passed the estate on after he died? 6. There's a real advantage to gift giving over estate transfer, right? Imagine for a large estate, imagine if you had $100 million. This would be a huge difference. We see people not taking advantage of this. The gift tax is woefully underutilized as a tax savings vehicle, right? You could really reduce your tax burden if you use the gift tax. Why don't people use it? We don't know. Part of this could be you can avoid estate taxes in general, and so that's one reason, right? You're not paying the tax anyway, so why give the gift? The second reason, and this is there's some anecdotal and some survey evidence for this, and I think it's kind of funny, is that one of the reasons people don't give their children their estates before they die is that everyone responds to incentives, right? And having an estate to hold over your children could theoretically be a way to get them to visit you, to be nice to you, to not put you in a home, right? These are all things that people want, and holding your estate over your kids, especially if it's a large estate, right, could really help sort of the comfort of your late years. Okay, and the last thing I want to talk about, so this is, you guys can go through this stuff on your own, is this last piece of it. So when we the estate tax is going to affect the savings behavior of donors, right? Because your incentives to save change if your estate is taxed more or less. It's going to affect the savings of the recipients because of the income effect of receiving the inheritance. It's going to affect the labor supply of the recipient. There's a good paper by Doug Holtz-Aiken that shows, Aiken, I can't remember, that shows that when people inherit money, they're more likely to drop out of the labor force. Interesting, right? To affect the labor supply of the recipient, it's going to affect the labor supply of the donor. If their estate transfer is taxed different.